There's a narrative spreading across headlines and social media feeds. Companies are leaving China, and the Philippines is next in line to benefit. It's a powerful storyline. It sounds dramatic. It feels historic. But is it true? To answer that, we have to slow down. Because what's happening in the global economy right now isn't a clean break. It's not a dramatic corporate exodus. It's something more strategic, more calculated, and in many ways, more interesting. For decades, China has been the center of global manufacturing. Since joining the World Trade Organization in 2001, China transformed into the world's factory floor. From electronics to textiles to industrial machinery, multinational corporations built vast supply chains rooted in Chinese cities like Shenzhen, Shanghai, and Guangzhou. The scale, infrastructure, and efficiency were unmatched, and that hasn't suddenly disappeared. Despite trade tensions, rising labor costs, and geopolitical uncertainty, China remains deeply embedded in global supply chains. Many multinational companies are still operating there. Many are still investing there. China's domestic market alone, with over 1 billion consumers, makes it difficult for global brands to walk away. So where does the Philippines come in? What we're seeing today isn't a mass departure from China. It's something called diversification. You may have heard the term China plus one. The idea is simple. Don't put all your eggs in one basket. Companies aren't necessarily abandoning China. They're adding another country to reduce risk. The COVID-19 pandemic exposed vulnerabilities in concentrated supply chains. Lockdowns in one region disrupted production worldwide. Then came escalating U.S.-China trade tensions, tariffs, and growing geopolitical rivalry. For multinational firms, the lesson was clear. Resilience matters, so they began looking at alternatives. Southeast Asia quickly entered the conversation. Countries like Vietnam, Malaysia, Thailand, Indonesia, and yes, the Philippines, started positioning themselves as complementary manufacturing hubs. But is the Philippines actually benefiting? The answer is nuanced. The Philippines has strengths. It has a young English-speaking workforce. It has a long history in electronics and semiconductor assembly. In fact, electronics already account for a significant portion of Philippine exports. Global chip firms have maintained operations there for decades. The country also has strategic geographic access to major shipping routes in the Indo-Pacific. There have been new investment pledges in recent years. Some semiconductor companies have expanded Philippine facilities. Certain manufacturers seeking redundancy have explored industrial zones around Manila and nearby provinces. Government agencies have actively promoted investment incentives to attract firms diversifying their supply chains. But here's the important part. This is not a tidal wave. When companies diversify away from China, many first choose countries with deeply integrated manufacturing ecosystems. Vietnam, for example, has seen substantial inflows in electronics assembly and consumer goods manufacturing. India has attracted smartphone production expansion. Mexico has benefited from nearshoring tied to the U.S. market. The Philippines is participating, but it is not the primary destination of a global corporate migration. There are structural reasons for that. Infrastructure gaps remain a challenge. Electricity costs are relatively high compared to some neighbors. Because logistic efficiency and port capacity still need improvement. Large-scale manufacturing ecosystems take time to build. They require supplier networks, transport corridors, policy stability, and scale. At the same time, the Philippines has advantages that shouldn't be overlooked. Its strength in business process outsourcing is globally recognized. It has decades of experience supporting multinational operations. Its workforce is adaptable and service-oriented. And as geopolitical tensions continue, companies are thinking long-term. Diversification is a gradual process, not a sudden relocation. So what does the data suggest? Foreign direct investment into Southeast Asia has grown in recent years as firms seek risk distribution. The Philippines has seen investment commitments increase in certain sectors, particularly electronics and renewable energy. But China remains one of the world's largest recipients of foreign direct investment overall. In other words, diversification is happening, but decoupling is not absolute. For the Philippines, the opportunity is real, but it's competitive. To truly capitalize on the China Plus One strategy, the country would need sustained infrastructure investment, regulatory consistency, and continued improvements in ease of doing business. Investors prioritize predictability. They analyze labor productivity, energy reliability, tax frameworks, and political stability. There is also a geopolitical dimension. The Philippines' strategic location in the Indo-Pacific places it at the center of regional security conversations. As global supply chains intersect with strategic alliances, investment decisions increasingly reflect not just cost efficiency, but geopolitical alignment. And yet, companies are pragmatic. They follow incentives. They follow markets. They follow supply chain efficiency. China's manufacturing dominance wasn't built overnight. It took decades of coordinated policy, infrastructure expansion, export promotion, and industrial clustering. Any country hoping to absorb even a fraction of diversified production must operate with similar long-term focus. So is the Philippines benefiting? Yes, but selectively. Certain sectors are gaining incremental investments. Some firms are hedging risk by expanding Philippine operations. The country is part of the diversification conversation. But it is not replacing China. It is supplementing a shifting global network. The more honest story isn't about a dramatic exit from China. It's about a more fragmented global economy. It's about resilience over concentration. It's about companies building parallel capacity instead of singular dependency. And in that evolving map, the Philippines has a seat at the table, though it still has work to do to strengthen its position. The real question isn't whether companies are leaving China for Manila. It's whether the Philippines can position itself strategically enough to capture long-term value from this global rebalancing. Because diversification is not a moment. It's a process. And processes reward preparation. As supply chains quietly evolve across Asia, the Philippines stands at a crossroads, not as a replacement for China, but as one node in a more distributed global system. The headlines may chase drama, but the reality is more measured, more strategic, and arguably more consequential. The Philippines is benefiting, but the story is still being written.